Welcome to the daily update, where I'll go over the action in the market for Tuesday, January 14th, and we'll see how things look for Wednesday, January 15th. Had another slight up day. The smart money indicators are still looking a little bit better, but all of our other primary indicators are still negative. So we're not really seeing any follow through with price yet. Growth is taking a bit of a hit compared to value in some areas. And we're seeing the small caps show a little bit of life, but can that continue? They came down to their 200-day moving averages, both for the S&P 600 and the Russell 2000, and bounced up off of that. So far, they outperformed, at least in Tuesday's session. We'll see if that can continue. Okay, let's go back and talk about what happened. We had a gap higher open at the open, and we got above R1 at 58.59. That set the high for the day. Just like on Monday, we had a gap lower open. That set the low for the day. So pretty much everything was set from a higher low standpoint this week so far, either at the beginning of Monday or Tuesday session. Then we declined down below the unchanged level. Of course, we went negative and we found support at the daily pivot at 58.16. And it was a real kind of a roller coaster day here. Prices went back above the unchanged level, hit resistance this time at R1, and then declined back below the unchanged level again, and found support at the daily pivot again. Then we climbed back above the unchanged level to close slightly positive. So we were up 0.11% on below average volume. There could be some wait and see mode. We have CPI coming out in Wednesday's session. That's the biggest inflation report of the month, and there's always an anticipation for it, but there's another anticipation for it this time as well. And we are, excuse me, still negative in the short and intermediate term. We're positive in the long term. The smart money indicators are still looking better, and I'll go through those charts. Interest rates came down a little bit, and there's the PPI came out that seemed to be just about right. And so, at least at the producer level, it's showing that, yeah, inflation's there, but it's not as bad as it feared. And it came in pretty much as the market had expected. So that was already built into the market. We did see a little bit of a pop after PPI came out. And then all the different geopolitical things going on. And of course, we have the inauguration, which will be happening in less than a week. We'll see. There's some confirmation hearings going on now. Just have to see how all of that works out. The whole LA fire situation. And there's lots to deal with right now. So PPI was cooler than expected. Based on what I was looking at, it came in about as expected, but the market liked that. So that kept things more in a positive stance. But the mega caps had another not very good day. They underperformed, and value ended up outperforming growth. So we took a bit of a hit with growth. Small caps did really well, and there's the bank earnings are going to be coming out starting at the latter part of this week and going into next week. And some of the regional banks actually look pretty good right now as far as earnings, at least the anticipation is. And so you've got folks buying into that. We'll see if it turns into one of those buy the rumors, sell the news type of events. The smart money indicators, they continue to improve, and they're positive for right now. We're still above the 100 period moving average with the S&P. The FANG index is above its 50-day moving average, and we're still bouncing up a little bit more off of the small caps, the two indexes that we follow from their 200-day moving averages. We still have a confirmed Hindenburg-Ullman. The NASDAQ and NASDAQ 100 are still below their 50-day moving averages. On a short-term basis, the Stochk RSI, CCI 14 and 20, and slope oscillator. Those are the same as what were on the list. Those are extreme negative. Now, the other ones are more neutral, if not looking a little bit better because we've been going up the last two sessions. The Arun indicator is still extreme negative, but that can take some time to actually pick up what's going on and change. No change to this scenario. We'll see if the Fed scenario and interest rate scenario, if this gets modified at all with CPI coming out on Wednesday. The dollar was down and interest rates were down. This helped give some support to stocks. We're at 4.79% with the 10-year yield, where we had been at 4.8%, 4.79%. We had been at 4.8%. And we're keeping an eye on the 30-year yield. It dropped down a tick to 4.98. We're watching that 5% level. Sentiment really didn't change at all. It's at 27. That's still negative. We're above that 25 level, but still looking pretty negative right now, where we had been at 27 before. No change with our trend. It's still negative. It's still getting stronger. It's still above 20, and the red line is still on top. I'm keeping our bias right now at mixed because a lot of there's really not much happening on the end of day change basis. A lot of tug of wars going on intraday. And I've changed our momentum from just flat out negative to mixed because we are seeing a little bit of an improvement there. Economic reports that came out, we had the NFIB Small Business Optimism came in at 105.1. Last time it was at 101.7. The big one was PPI, came in 0.2%. They expected 0.3%, down from 0.4% that we got in the last reading. Core PPI, the inflation component, was unchanged. They expected it to be up, and prior it was up 0.2%. So here's the charts. The NFIB Small or Business Optimism Index is showing an improvement here, and that's encouraging because most folks end up working for a small business. Here's the PPI year over year, where it's starting to go back up here, both with the total reading and with the core reading. A little bit inflationary there. The final demand for goods and services, both are going up with the blue line and the yellow line. Intermediate goods also going up here, more with the unprocessed goods, and still going up slightly with the processed goods. Here's PPI, how I look at it on a rate of change basis. First, we look at it year over year, where we are starting to go back up a little bit now. This is that sticky inflation that just doesn't want to go away. And then the month over month change was up just a little bit there. The core PPI is flattening out on a year over year basis, but going up ever so slightly. And we did decline on the month over month basis. So Isabel Net blog charts coming down here, dropping below 50 with the overbought, oversold composite. And that's turning things a little bit more negative. Now we're getting a negative reading on the chart that we look at. This is more of a composite of different sentiment gauges taken together. And it's just showing when we get down into this blue area, it's not only neutral, but when we drop below 50, looking a little bit more negative because the context is we're going down. Then, since the jump post the elections, equity positioning has been in an elevated range. Just shows that a lot of folks are still in stocks, even with the recent weakness and frustration that we've been seeing lately. Folks are still heavily weighted in equities right now. And the sectors that are announcing buybacks now, they're coming into their lockdown periods for a lot of these companies that will be reporting earnings. But we're seeing an awful lot of buybacks in healthcare, and that's a defensive area. And healthcare has really been getting hit hard. Energy, another weaker area. A lot of folks are coming in and buying, thinking that maybe the economic situation is going to change. We might get more defensive in healthcare, so there's some buybacks going on there. And energy, financials have still been strong. They're doing better this week after coming under some pressure with the rest of the market. And then the least number of buybacks right now are in the utilities as well. This is a variation of a chart that I show over the weekend every week, and I showed in Friday's video as well, the bull-bear spread from the American Association of Individual Investors. This shows the same chart that I was showing, where we're actually dropping negative here with how individual investors are feeling. Equities continue to show rate sensitivity with holds with yields above 4.5%. Yeah, we've been holding up, but it was at 4.5% level. That's when we started to really run into trouble. And so the PE ratio is actually going down a little bit. We're still well above 20 here. We got quite a ways to go to get down here. But this is what's been pressuring stocks. This is kind of the story right now. Magnificent Seven, it's expected to generate earnings growth of 33%. Now in 2024, because they're starting to get ready to report their earnings, where the rest of the S&P grew by 3%. So this is the estimate here. that they're looking at. And then what is it looking like going forward? Still positive. You still have the Magnificent Seven outperforming, but you see other stocks coming up. We'll have to see if that ends up playing out that way. Currency futures positioning, a lot of money in the US dollar right now. That's kind of the place to be. We're wondering, you've got these people saying, oh, the dollar's overvalued, it's overextended to the upside, we're overbought, it should be pulling back. And that could end up happening, but you've got a lot of folks that chase what's already been successful. And so far, for the last period of time, it's been the dollar. The break-even inflation, this is projected looking out, and the takeaway from this is 5 years, 10 years, 20 years, no matter what you look at, they are expecting inflation to pick up. And valuation increases have significantly contributed to the performance throughout 2024 and accounting for nearly half the return for the rest of the stocks in the S&P 500. And this is the valuation. This is looking at the forward PE ratio and then the valuation itself, and then their performance is taken together. And this kind of goes with what we've already been seeing. The Magnificent Seven are doing well, followed by the S&P 500, and then other indexes that follow along the way, with emerging markets coming in last on this chart. And let's see, hedge funds most bullish on the dollar. We just saw a variation of this chart in yesterday's video, but hedge funds might be big money, but they're not necessarily the smart money. They're really heavy into the dollar currently. And this was kind of interesting. Here's the small business optimism. It keeps climbing on Trump optimism as well. And it just shows that small businesses seem to favor the new change that'll be coming for the administration. And the dollar here, and coming up to a pretty high reading. You look at all of this together. These are different times and different returns that the dollar has had. And then this is the gold average performance over the next year. And that tends to do well for gold at the same time. And we want to keep an eye we're watching interest rates, and we're also keeping an eye on the dollar right now, where you can see a really strong correlation between the 10-year yield and the dollar itself. And if interest rates start to come down, that may mean that the dollar starts to come down, or the other way around with that. If the dollar's declining, then interest rates might start to come down as well. So here's our intraday chart. We set the high right at the open. We gapped up above R1, and then that was it. We just kind of chopped around a little bit, came down below the unchanged level, found support right around the daily pivot, went back positive, could not get above R1, came back down to the daily pivot, and then ended up closing slightly positive. And down just a little bit in the initial overnight session. Things might be relatively quiet ahead of CPI coming out before the market opened. Still taking a hit, but looking positive here with large cap growth, blue, still outperforming large cap value on the intraday chart. Taking a bit of a hit here as well, but still holding up if we go back to the end of November with the S&P intraday growth to value ratio. And here I have the same. Okay, this is yesterday's chart that I forgot to get rid of. Okay, so growth was actually down in Tuesday's session where value was up. But growth did better for the mid caps and a little bit less than as good for the small caps, but still pretty good in and of itself. So we're coming down a little bit with small cap growth to value ratio, mid cap growth to value ratio. Actually ticked up just a little bit here with S&P growth to value on an end of day basis, and this continues to hold up. And the growth versus value ETF, this is taking a bit more of a hit now, as we're seeing some of the improving areas over the last few sessions have been more value rather than growth. But the discretionary to staples ratio, that still continues to be strong, and that's positive for the market. We're still below the 50-day moving average with the large cap growth ETF, and it was down another 0.43%. Still negative with our trend. We're in a trending environment because the ADX, which is the black line, is above the moving average and the red line's above the green line here. This is intermediate term. We're also continuing to be negative in the short term with the trend. And we dropped a little bit below average here with volume in anticipation of CPI. And the Ulcer Index is continuing to go back up. It's above its moving average and climbing. This is another sentiment gauge. We ticked down on a closing basis with the VIX after getting close to that 20 level. We're still getting a high reading right now, both with the line chart and with the bar chart. And the VIX of the VIX also declining, usually when the VIX itself declines, but we're still above the moving averages here with the bar chart and the line chart. Momentum in the VIX continues to be up, which is negative for stocks. We're really spiked back up again here with the skew index. We had been dropping down, but we really spiked back up in Tuesday's session. So the market is still expecting some kind of a big move that hasn't happened yet. And we ticked down just a little bit with this fear gauge, and we ticked down with the other fear gauge. So we're seeing a bit of a confirmation there as fear is dropping off just a little bit. Really came down with the equity put call ratio on a 1 day basis. And so that's rolling over our 5 day chart just a little bit. Here's a longer term look at that. We're just above this green line here, which is an extreme negative reading. And we're ticking back down now with the 10-day equity put call ratio, but no real trend is happening with these charts. We're just kind of chopping around these days. And still getting a fairly low reading with the volatility risk premium. We're still near the lower end of the band. And a little bit of an improvement with our advanced decline line based on price and volume. We're still positive since we're above the longer term moving averages. Not much of an improvement here with the highs lows. We saw them about even, but we're still going down. We haven't crossed back above the moving average with the 5 day, and we're starting to flatten out here with the 10 day. So little subtle improvement here, but not switching over to positive. This is where we are positive still. We're above the moving average with accumulation distribution. Ignore the boom indicator for right now. It's trying to measure the distance away from the moving average. From the indicator is from the moving average itself. And you can see it's clearly off right now. Showing a bit of an improvement in the short term, just barely going positive with our short-term advanced decline ratio, coming up, but still negative with our longer-term advanced decline ratio. Looking better here, another smart money indicator with the chicken money flow, still showing an improvement there, and we're continuing to go up and crossing above the midpoint with our chicken oscillator. So our three smart money indicators continue to be positive and continue to improve. We're still negative though with the vortex. The red line is above the green line. Not much of a change here with the cumulative advanced decline line based on price or volume. Seeing an improvement here with the advancers minus the decliners with a 10-day moving average, but we're not above zero yet. We won't be positive until we do cross above zero. And not really seeing much of an improvement here with the 10-day average of the highs and lows for the S&P. Still getting quite a low reading below 50. And still bouncing up off of the 200-day moving average with the NYSE advanced decline line. I also plot the S&P here just to get some kind of a take on, even though they're different areas of the market, sometimes looking at them together can give some insight. And then the NYSE advanced decline line on a cumulative basis did improve. We're still below the moving average here and chopping with our regular NYSE advanced decline line, and seeing that same thing with the other NYSE advanced decline line. Little bit of an improvement with common stock on the NYSE based on price and volume. An improvement, but still negative here with our advanced decline line studies. We're still below the moving averages with all the indexes. And improving here with those stocks above their 20-period moving averages, but not quite back up to 50 yet. So we're seeing some subtle changes here. Not enough yet to really kick our study into gear. Now, one takeaway from this is if we continue to go up, we came down, we set a low, then we set a higher low, and then we came back down and set an even higher low here. That could be positive. Now we need to see some good upward thrust here that'll take us above 70, and that would suggest that the short-term momentum is positive. And an improvement here with the stocks above the 50-day moving average, but still below 50 itself. And an improvement with the 100-day and 200-day moving average studies. So we're seeing some internal strength that's improving things, but not actually switching over to positive yet. So here's the daily chart. We were below average with volume, and we're still holding up above this pivot point here. That acted as a pretty good level of support in Monday's session, and then also in last Friday's session. So we've been holding above that for right now. And then just this is just a blank bar chart right here where we're still seeing a rather vulnerable chart where we set the high and then we came down and set a low and then we set a lower high and barely made a lower low, a lower high and then a lower low. If we go back up, we'll want to exceed these previous lower highs to kind of break this negative pattern that we're seeing here. And of course, right now it looks like, okay, this could show some vulnerability and really end up taking things lower. Seeing an improvement with the 20, 50, and 200 period moving average studies on the S&P. Still extreme negative with the Stochk RSI, no longer extreme with the Williams percent R. CCI 14 is still extreme, as is the CCI 20. Nothing is extreme now with stochastics. That just shows how choppy we've been because these things usually get pegged one way or the other. We're going up a little bit in the short term, still declining in the intermediate term and declining with the long term. And this is just a further subdivision of the short term time frame. A little bit of an improvement, but still negative with the force index. Our short term trend is measured by 20 periods, still going down. We haven't cleared both of these lines yet to turn them back up. And we're still below the simple and exponential moving average based on 20 periods. Showed a little bit of an improvement here, going from the -2 channel up to the -1 channel with our standard deviations chart. And we were looking a little better with the balance of power. Now we're coming back down and we're right at zero. So this chart is pretty much neutral at this point. Still negative with the go, no go with the dark purple lines. And bouncing up a little bit off of the lowest low value here, but still below a declining midpoint. The TTM squeeze continues to be negative with the darker red. And a little bit of an improvement, but still negative with the ease of movement. The Arun indicator is still giving us an extreme negative reading and hasn't really changed. We are looking more positive here with the McClellan oscillator for the S&P. We crossed above zero. So it's really hard to see, but we're starting to turn back up based on price and just barely starting to go up based on volume. So this is slightly turning positive if it can hold. We also crossed above zero with the McClellan oscillator for the NYSE. So you can't even really even see it. We're just ticking up a very, very little amount here based on price and just a little bit here based on volume. But we have to see more follow through to see if things are turning back more positive. Looking a little better here with the Swenlin trading oscillator. We're crossing above the midpoint based on price, but we're seeing a negative divergence because we're going down based on volume. They're going in different opposite directions here. Momentum is still negative with the PMO going down, but we are seeing an improvement based on price. It's volume that's kind of lagging behind currently. A little bit of an improvement here with the PMOs that are rising. The buy signals are going up, and we're flattening out after declining with the PMOs above zero. So very subtle, small improvements. But we were seeing these last week, and then we had a down day and wiped all the improvements out. So we just look at these things and notice them and then see, is there follow through with price? And here's the condition of the intermediate term trend, still below the blue line or red line, so they're still going down. That's showing vulnerability still. We're below the 50 period simple and exponential moving averages as well. We're still above the 100. That's 3 days now. We came down and hit that support on Friday. We opened below it and closed above it on Monday, and we're still above it in Tuesday session. So this is potentially holding as support. And we're seeing the short-term moving averages coming down and starting to mix up here with the intermediate term moving averages, but the 100 period moving average is still providing support. And we're neutral now with the Elder's Impulse system for the S&P after being negative. We're still negative with the parabolic SAR with the dots on top. Still looking extreme negative with the slope oscillator and now going sideways. The MACD, though, is still declining and has not switched over to positive. So we're sideways with the short-term slope oscillator. We're still declining with the TSI. All of our intermediate term and long-term oscillators continue to decline and still below the moving average of the Kopik curve, which this is another momentum oscillator. Ticking back up, but more neutral with the Sean trend meter. We're below 50 and declining with the money flow, where we're actually barely crossing above 50 here with the ultimate oscillator. So a bit of a mixed picture between those two indicators. Still looking okay with the on-balance volume since we're above the moving average. But when we look at RSI, different measurements here based on 14 and 9 periods, we're still below 50 with both. And we're watching this to see, is the mass index going to generate a signal? There are 3 points to a signal here. The first one is going above the red dash line. The second one is above the blue line. Now the third one will be crossing back down below the red dash line again. And whatever it took for this signal to be generated, the mass index is anticipating a reversal in that. We are still working off of a buy signal with the Pring bottom for sure. And not much of an improvement here. It's still looking negative with the bullish percent index below 50. It bounced up a little bit, but it hasn't even crossed back above its moving average yet. A little bit of a tick up with the NYSE BPI, and we were flat with the NASDAQ 100 BPI, and it's still below 50. So not much of an improvement here. We're still below the cloud here with the Ichimoku cloud, and the blue line still below the red line, and we were up slightly here with the green line. And this is longer term where we came up to this trend channel here, and that's when we hit the high in early December. And since then, we've been having some problems. We're still looking more negative with the hike in ASHI, different ways of measuring the trend. We're negative with the KEGI, but now we're pointing up. The Renko chart is still negative with red blocks, and we're still negative with the three-line break. So again, a bit of a mixed picture there, but maybe some improvements. A little bit of a tick up with our 150 and 200-day moving averages. And we've changed over to positive with the mid caps in the short term, but we're still negative with all the other indexes. And the mid caps and small caps are still negative in the intermediate term. Bonds are still negative across the board based on price. Commodities are positive in the short and intermediate term. And the dollar continues to be in an uptrend on all time frames here. And initially, we saw the NASDAQ crossing below 19.1, then it got back above there, then it went above 19.2, then later in the day, it went back below 1900. And we have the euro, which has been going down when compared to the dollar. We did see the materials BPI cross back above 20. It's not been a strong area at all lately, so this might be getting a bit of a bounce right now. And most of the sectors ended up being up, but discretionary and communication, two growth areas, they were down. And then the other growth area that we keep an eye on is tech. It was up by, but not by very much. And seeing a little bit of an improvement here with the equal weight versus the weighted version of the S&P. And we're seeing this coming down now as the equal weight or value stocks have been outperforming. When we were really going up with the S&P, this ratio was going up. Now that it's starting to come back down, that's why we're not seeing a lot of real bounce in the S&P weighted version of the index, at least yet. And the Dow kind of coming back up into the range that it's been in for quite some time. We're still neutral with the diamonds, still below the 50-day moving average with the NASDAQ and the NASDAQ 100. And we're still negative with the Qs. When looking at the Elders Impulse system, the momentum for the NASDAQ 100 is still negative, and we're still below the 50-day moving average with the triple Qs. Small caps bouncing up here, up 1.38% after coming down and testing their 200-day moving average. But even if they go up a little bit more from here, we're still just going to be right back in the range that we've been in. We're going to need to really clear this, get above the 50-day moving average for this to look more positive. And the Russell 2000 small caps also came down to their 200-day moving average. So far have bounced up off of that. We're improving with the RSI, but still below 50, and the momentum continues to be negative. And we've gone from negative to neutral for the small caps with the Elders Impulse system. The mid caps, again, saw a nice day up 1.18%, but still just coming back into the high end of the recent range. And going from neutral to positive with the mid caps with the Elders Impulse system. The Wilshire was up 0.23%, but still below its 50-day moving average. Also, still below its 50-day moving average with the total U.S. stock ETF. Financial sector seeing a little bit of front-running buying before earnings start coming out, up 1.24%, but still below their 50-day moving average there. Still above the 50-day moving average, just barely, with the FANG index. These are the mega caps, and so far this has been holding up for right now. If we break below that, that's going to turn things more negative. If we can bounce up off of that, that of course would be more positive. Coming down here to this longer term trend line, so far this level has been holding for the FANG index. Apple was down 0.48% below its 50-day moving average, Amazon was down 0.32%, still above its 50-day moving average. Meta coming back down to its 50-day moving average. Google down also, but still above its 50-day moving average. Dropping further below its 200-day moving average with Microsoft. And Nvidia was down over 1% and below its 50-day moving average. And weakness in this area, these are why we're having trouble with the indexes going up. Tesla was down 1.72%, but still above its 50-day moving average. Netflix, under its 50-day moving average, down 1.41%. And seeing a bit more of an improvement on a short-term basis when we look at U.S. stocks versus world stocks. Longer term, the correlation is also strengthening. Oil coming down from where it was, it got up into the 77, 78s. It's pulling back just a little bit, but higher because we've been camped out around the 70 level for quite a while there, and now we're breaking out a bit to the upside. Semiconductors up 1/3%, just a little bit off of its 200-day moving average here with the SMH Semiconductor ETF. And after hitting these series of highs here, still coming back down into the rainbow. The Dow Jones Semiconductor Index was down 0.43% and below its 50-day moving average. And this is the SOX index, another way to measure semiconductors, still underneath its 50-day moving average and in a downtrend, even though it was up 0.2%. Semis to tech ratio, we saw a real breakout with semis outperforming over the last few sessions. We've just been chopping lately. The dollar pulling back after it's been strong, but it's still in an uptrend overall. Coming down slightly here with the 10-year yield, going up just a little bit with the 10-year based on price. Seeing a bit of an improvement here with home construction to 3 to 7-year bonds, but we're still well below this 250-day moving average. This is really taking a bit of a hit right now, and we'll see if we get any more follow-through improvement there. We're watching the Japanese 10-year yield because that's what caused all the problems last summer, and it's continuing to go up. That's the red line here, and that could pose some problems if these interest rates continue to go up. And we're still below the 200-day moving average with the total bond ETF. We dropped below that. That was the hope, was it was providing support. And even though we ticked back up, we're still below that. So now we're going to have to try to get back above that to see bonds turn more positive. We're also keeping an eye on the 30-year yield. I have a blue line right here at 5%, and we're still below that level. Even though we hit it a couple of times intraday, we have not closed at 5%. And seeing a little bit of weakness here with our growth to value ratios coming down below the moving average with the Qs to S&P and right on the moving average with discretionary to S&P, dropping down below the moving average when we compare large cap growth to large cap value. So dropping below the moving average with the large caps, back down to the moving average with the mid caps and the small caps. So what's our outlook? Earnings season will start at the end of this week, and banks are usually the first to report. And so that's going to be highly anticipated there. We're still dealing with somewhat of an oversold condition, even though there's some improvement in the short term, but we're still negative in the intermediate term. And we're going to get the MBA Mortgage Applications Index and CPI will be coming out. That's the biggie. And Empire State Manufacturing, that report will come out as well. And then all the different geopolitical things, just to keep an eye on those. Then in Thursday's session, we'll get retail sales and initial jobless claims. And then there's other reports coming out, but not as influential. Here's a look at what the previous readings were and what the forecasts are for the economic reports. And then seasonality, neutral to positive with the Dow and S&P, neutral to negative here with the NASDAQ. So no real edge either way there. And here is CPI pretty much flat as far as seasonality when we look at the S&P in a post-election year. And we're starting to come out of the first half of January, which usually is a better performing part of the year. Now we're going into the second half, which is okay, but doesn't tend to perform as well. We'll see if maybe they flip-flop this year. And small caps, which are doing good, at least in Tuesday's session, but they still have a long way to go to meet expectations of what was hoped for. And we're still in the positive time here with Tom Bowley's research for the month of January before we head back into a more negative time. So the warning signs, we're still negative with our advanced decline line. And we're actually going back up again here with the 5 and 10-day equity put call ratios. Actually, that's not correct. They're actually going back down a little bit. They've been so choppy lately. And we're still not really positive. We're showing some improvement with the bullish percent indexes, but they're still negative. The parabolic SCR is negative. We're seeing a divergence with the Swenlin trading oscillator. We're going up on price, but down on volume. We're still negative on a momentum basis, and we have a confirmed Hindenburg-Ullman. The vortex is negative. Our moving average studies improving, but negative. The ease of movement is negative. The money flow is negative, and the momentum for the NASDAQ 100 is negative. But we're seeing some signs of improvements here with our smart money indicator still looking better. We're just not getting a lot of confirmation with our other indicators. Growth is pulling back, but it still has been holding up. Discretionary to staples, though, has been doing better. And we're turning back to positive with the McClellan oscillators and summation indexes for the NYSE and the S&P 500. And we're still above 50 with our 200 period moving average. Steady there. The ultimate oscillator is turning positive. The financial sector still looking longer term positive. And then here's an update of the Hindenburg-Ullman. No additional spike now. We just had that one confirmation, and to this point, no additional confirmation. So our conclusion, we're negative, but we're showing some improvement. Large caps in growth still holding up for right now, but have been pulling back. And support with the 200-day moving average for the small caps and really the 100-day moving average with the S&P and the 50-day moving average with the large cap growth. No, whatever the 50-day, the FANG index, that's still holding for right now. And we're still negative in the short term, but showing signs of improvement. We're also improving in the intermediate term, and we're really keeping an eye on that 100-day moving average, but we're still positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.